We can now look at part 2. So for part 2, it says you are a junior tax consultant working at Tax Advisors Pty Limited. Thomas Jones has approached your firm with a request for tax advice. You are required to write an email to Thomas Jones in which you explain what the consequences will be of the transactions or the events described. You are required to address the events that took place during the current year of assessment as well as any future years. So the events that will take place. Right, so this is Thomas. So guys, this is obviously a discussion question, and I've given you guys a solution which for myself, so I'm not going to write all of that out. What I'm going to do is I'm going to talk to you guys a little bit quickly about how the calculation would work. And this is how I would suggest that you approach it. Most of us understand how to do the calculations. Obviously, if you don't know the calculation or anything, then you don't know your work. But what happens with a vesting of a share? Right. You paid 150 rands for a share at a cost of 1,000 rands for a share. So on the date, so I'm going to make a comment here, like date of offer, of option. So the date they tell him that he has the option, nothing happens. When you just get an offer for something, and you don't do anything about it, nothing has happened. Right, then they give him the offer, he accepts the offer. Right, the moment he accepts the offer, you perform the following calculation. You say number of shares times the market value of a share less the consideration, how much did you pay. That amount gets included in your gross income. Now, immediately at this point in time, you now have to ask yourself, okay, because what happened here? The idea here is, so he pays 1,000 rands for a share. You can see deliberately what I've done here is I haven't given you values because I didn't want students to just focus on that. I want to see if you can explain yourself. Okay, so I'm just giving you as an example now. Let's say at this date when he got it, the market value of the shares were 2,100 rands a share. So you would then say 150 shares times 2,100 minus 1,000 rands. Right, that's what I'm trying to say. And that would be included. Now, the question that you have to ask yourself is this amount that was included in here. Does this taxpayer at this point in time, when we include it, have an unrestricted rights to the instrument? In other words, this taxpayer can do whatever he or she wants to do with it. So Thomas, can he sell it if he wants to or not? He can't, because they cannot dispose of it for a period of 3 years or until he resigns. So, if that happens, you would then have to apply section 10(1) which says that that amount is fully exempt. So they don't want to tax you because it's not unrestricted yet. So that's the current year. Then in the future, 3 years from now, when it vests, so remember, 1st of August, so 3 years from now, on that 1st of August, when it vests, he will do the following. He will say, number of shares times market value on the vesting date. Right, so 3 years from now, what is the market value 3 years from now? The market value is 3,000, let's say. Right, so market value of vesting minus the consideration. So if 3 years from now, guys, 3 years from now, this is all just hypothetical, the shares are worth 3,000, you would deduct 1,000. Also remember, Section 8C is interesting. Right, Section 8C is interesting because if this market value, which I now say is 3,000, goes down, let's say it goes down to 800, you will have a deduction. Just remember that. Okay, so you now include that amount when it vests. Now it gets taxed. That's it. Then, when sold, if you then sell it, if it's gross income, goes here if it's a share dealer. If not, there's a capital gain, and it'll be the proceeds will be whatever the proceeds is, and the base cost will be that amount which you've included. Right. Because that's the portion that has already been taxed. You can't get taxed on it again. That's the idea behind it. So guys, just to take you to my solution, I'm going to quickly talk through it. So first of all, very important guys, they ask you to do an email, so you have to give an email format. I didn't show it now here. I just obviously tell you to do it, but you should say to thomas@email.com from student@email.com. Subject, advice on share options. Now, think about this. Majority of you guys are working. If you're not working, you've definitely seen emails in your life before. All that they're trying to do, what the examiners are trying to do here is, this is part of the thing is of trying to also prepare you for APC, where they also will tell you, write a report, write an email, do this, put together a spreadsheet, put together a PowerPoint presentation, whatever the case might be. I want you to understand, they want to see, do you know, can you follow instruction? Do you know what they're saying there? So just do that. Thomas at email, student at email. Please don't write your name. Please don't write Michael Jackson. Please don't write, I don't even know who's interesting anymore. It's pretty crazy if Michael Jackson's the only person I can think of. But, right. Don't write names. Just student or candidate or something like that. Don't write names. You can't write your name in an exam. Definitely not also for at SACA level. And if there's another name, if you write Michael Jackson, there are definitely people who are called Michael Jackson, so then they have to go and see if you are really called Michael Jackson. Delays the process, it's a mess. You don't want to go through, you don't want your paper pulled for any reason, for any irregularities. You just want to be a normal student, showing the examiner that you know what you're doing. Okay, so that's it. No clowning around. You can become a chartered accountant, stand-up comedian once you've qualified. So, basically, we just talk here. You'll have to include it in business section 8C. In the current year, you get 150 shares, but they're restricted because you can't dispose of them. You'll include the amount in your gross income. You'll claim an exemption for it because it has not yet vested. Then 3 years from now, when it vests, you will include an amount in your gross income, just calculate as follows. You can see it's exactly what I wrote down, right? And this will be a gain or a loss, and when it's disposed, it'll be a capital gain. So that's it, guys. It's pretty standard stuff. If you know your theory there, it shouldn't be a problem. If you don't know your theory, it's a nightmare situation. Okay, so that's it. In the next question or next video, we'll start with the next part.